Welcome to Talk Tickers. Today, we're digging into the Q2 2025 earnings for Genius Sports. And wow, what a confusing quarter. You've got record operational strength, some huge strategic wins, and then the stock price just tanks. So what's really going on here? Let's break it all down. All right, here's how we're going to tackle this. First, we'll look at the numbers versus what Wall Street was expecting. Then, we'll get into the real story, their core strategy. After that, we'll see why management is so bullish, try to figure out why the market reacted so strangely, and then, of course, we'll wrap it all up with our take. So this quarter was a real head-scratcher for investors. It's a classic case of a company showing amazing strength on the top line, only for that to get totally overshadowed by some noisy, kind of confusing accounting on the bottom line. So yeah, the results were definitely a mixed bag. On one hand, Genius beat on revenue, posting a really solid 24% growth. But, and this is a big but, the number that really grabbed the headlines and probably spooked a lot of people was the GAAP earnings per share. A huge miss at negative 21 cents. But here's the thing, the real story, the number that management wants you to look at, is that record adjusted EBITDA of $34.2 million. Okay, so this is where it gets really interesting. You've got this stark contrast. The good news? It's all about how well they're actually running the business. Their adjusted EBITDA margin shot up by a massive 700 basis points to a record 28.8%. And get this, they converted their revenue growth into profit at an incredible 57% clip. That's fantastic. But then you have the bad news, that big GAAP net loss. And it turns out that loss was almost entirely driven by one-time, non-cash stuff. Stock-based compensation and warrants for the NFL, things that don't really reflect the day-to-day health of the business. All right, so let's zoom out a bit. How does all this financial stuff connect to the company's big picture strategy? Because this is the real story you need to understand with Genius Sports. Okay, management's whole game plan, everything they talk about, is built around this one idea, their data rights moat. Think of it like a fortress. It's not just about having a bunch of sports data. No. It's about getting exclusive, long-term access to the absolute crown jewels of sports content and locking the door behind them so nobody else can get in. And believe me, they have been busy reinforcing that fortress. In just the last few weeks, they've extended their exclusive deal with the NFL all the way through the 2030 Super Bowl. That's huge. And maybe even bigger, they went out and grabbed the exclusive rights for Italy's top soccer league, Serie A, and a massive bundle of other European soccer leagues. They've basically locked up a ton of premium content for the rest of the decade. Now, this is what I find so brilliant about their strategy. They're not just throwing money around and outbidding everyone. According to the CEO, they're winning these huge deals because of their technology, their Genius IQ platform. It actually lets them get these rights on better terms. In fact, he pointed out that those new European deals cost them, and I'm quoting here, just a fraction of what the last guys paid. That is a massive advantage. So they're building this incredible moat. It's no wonder management sounds so confident about what's coming next. Let's take a look at their forward-looking guidance. And they backed up that confidence by raising their full-year guidance. They're now targeting $645 million in revenue. That's 26% growth. But the really eye-popping number is their adjusted EBITDA target, $135 million. That is a massive 57% jump year over year. What that tells you is they expect their profit margins to expand a lot. We're talking about hitting around 21% for the whole year. So where's all this growth coming from? Well, the main engine is still their betting technology segment. I mean, it's a beast. It accounts for almost 3/4 of their total revenue, and it's growing at over 30%. So yeah, the core business is absolutely humming. But here's the kicker. The story that management really wants investors to focus on for the future is media tech. They jacked up the growth forecast for this segment from the low teens all the way up to the low 20s. Why? Well, they just signed a huge new partnership with an agency called PMG, and get this, they've already completely sold out all the ad space for their BetVision NFL product, and the season hasn't even kicked off yet. That's a huge sign of things to come. So you hear all this, right? Strong results, raised guidance, big new deals. You'd think the stock would soar. Well, that's not what happened. The market's reaction on earnings day was, to put it mildly, bizarre. Just look at this timeline. As soon as the results hit, the stock shot up to a new 52-week high in pre-market trading. Perfect, right? Wrong. From the moment the market opened, it just bled out all day. It ended up closing down almost 5%.
I mean, that is a textbook sell the news reaction if I've ever seen one.
And this wasn't just a quiet little dip either. The trading volume was more than double the average. That tells you there was a serious battle going on. Big money was moving, and investors were clearly rethinking their positions on the stock. So what gives, right? Why this massive disconnect between the great news and the ugly stock chart? Well, it looks like a classic case of profit-taking. Remember, the stock had already run up more than 24% in the month leading up to the announcement. So it seems investors just decided to latch on to that messy GAAP EPS number as an excuse to cash in their chips, completely ignoring the fantastic underlying strength of the business. So that brings us to the big question. What does this all mean for you, the investor? Well, whenever you see a disconnect like this, strong fundamentals, weak stock price, it often spells one thing: opportunity. So let's get to our take and how we think this could play out. All right, so here's our call. We're giving the stock an outperform rating. We just think the market is getting this wrong. It's getting bogged down in the short-term accounting noise and completely missing the bigger picture here. This is a company with a powerful long-term story of expanding profits, all built on that technology-led data moat that just keeps getting stronger. So if you're looking for a way to play this, here's an idea: a long-term bullish call spread. The core thesis here is that Wall Street is still sleeping on the media tech segment. Remember, management thinks this could one day be even bigger than their main betting business. So the action would be to buy call options, maybe around an $18 to $20 strike. But you want to give it time to work, so look at an expiration date that's 12 to 18 months in the future. Then, to help pay for it and define your risk, you could sell some further out-of-the-money calls, say around a $25 to $28 strike, against that position. So really, it all comes down to this. Is all this short-term noise a real red flag, or is it a golden opportunity for the long term? We think the answer is pretty clear. But of course, please remember, this is not financial advice. You should always do your own research and make any investment decisions with the help of a professional.